Okay, Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh. So this is a recording for Finance, Chapter 8, Project Budgeting Part 2, Cash Flow Analysis. Okay, so firstly, let's look at the learning outcomes of this chapter. Okay, by the end of this lesson, students will be able to, number one, understand capital budgeting concept. Okay, this is basically what we're going to learn today. Okay, the capital budgeting. Okay, number two, perform cash flow projection. This is very important. Okay, so far, in final exam, this would be the largest chunk of calculation parts in the final exam. Okay, I will also say that this would be the most difficult part in final exam if it is tested. Okay, and number three, calculate payback period and net present value. Okay, so let's look at the introduction. Okay, so what is capital budgeting? Capital budgeting is a process of analyzing a project through its potential cash flow. Okay, so the whole process, okay, the idea is that, okay, um, before we ever start any business, okay, our focus here is we want to know if the project is profitable enough or not. Okay, like for example, okay, let's take all the courses that you learn in CFSIUM. Okay, firstly, you take accounting, right? Okay, accounting is basically you learn how to record the transactions. Basically, you're already in the business, okay, and the transaction happened, and now you learn how to record it. Okay, for economics, okay, you learn the big picture of the economy. You learn how monetary system works, how fiscal policy works, the demand and supply in the market, right? In business, you learn how to run your business, how to do marketing, how to price your product. Okay. But in finance, when we talk about capital budgeting, we are talking about before you even start your business. Okay, you want to make the decision. Should I go into this business? Should I start this business? Okay, this is what you do. Okay, we call it as capital budgeting process. Okay, so among the processes involved would be, okay, firstly we have to identify the best project. Sometimes you have multiple ideas. You might want to do business in F&B industry. You might want to go into photography business. You might want to go into homestay business, for example. Right. Okay. You can have many ideas at the same time. But firstly, you need to identify which one is the best idea. Okay. Number two, you have to research the market for data. You have to look at the market, okay, in terms of the profitability, in terms of sellability of your item, of your product or your services, right? Okay, number three, assessing capital requirement. Once you identify, okay, there is a demand for it. Okay, now let's discuss about where you get your money. Okay, so far you have learned that there are two sources of capital. Okay, the equity capital and debt capital. Okay, you have to consider which one is the best, or maybe some sort of combination of the two. Okay, next, estimating the initial cost. Okay, for us, okay, for capital budgeting process, we start focusing from this part, assessing capital requirement. Okay, because we in finance we are talking about in respect to capital, we are talking about the cost of capital, right? Okay, so we start our discussion extensively on the cost of capital, and the whole cash flow analysis process will begin at estimating the initial cost. So today in this recording, okay, I will explain to you, I will show you how to do the cash flow analysis and how to do the whole capital budgeting process. Okay, and then projecting the future cash flow, analyzing the cash flow using capital budgeting techniques. Basically, everything is in this part. Okay, so let's look at the next part, 8.2. You can read on your own. Okay, I prefer to straight away go to the calculation part. Okay, because this is the part that we're going to discuss in our class this week. Okay, so firstly, cost of capital. Okay, just to refresh your memory very quickly. Okay, when we talk about cost of capital, we are talking about the cost that we have to pay if we get the capital. For example, if the capital is debt capital, okay, if it is loan, okay, what is the cost that we have to pay? We have to pay the interest, right? And if, for example, we get equity capital, and let's say the capital is shares, so we have to pay dividend. Okay, so these are the cost of capitals. Okay, dividend and interest. Okay, now um we also have discussed about this part in the past. Okay, for this one. Cost of utilizing debt is usually cheaper than the cost of equity due to their risk. Okay, we have to talk about how, in most cases, interest rates charged by bank would be lower than dividend that we pay to our investor. Okay, due to the lower risk of banks in terms of giving out loans. Okay, so hopefully, I really hope you understand this. Okay, because this is just to rationalize. Okay, later on, in case you're wondering why the cost is lower, okay, hopefully you can understand the reason from this. Okay, so let's go straight away to this formula. Okay, so this is the first formula that we have. This is what we call as CAPM. Okay, capital asset pricing model. Okay, what is the use of CAPM? CAPM is used to measure the cost of equity. Okay, for example, if we want to talk about cost of debt, okay, let me use this Excel sheet to explain to you. Okay, earlier we talked about there are two types of cost of capital, right? Okay, cost of capital comprise of number one, cost of debt. In this case, we put it as KD. Okay, don't ask me why. That's just how the way it is. And then we have cost of equity, KE. Okay, and cost of debt, as we discussed, this will refer to the interest, and cost of equity, this will refer to dividend. Now, in terms of interest rate, how do we get the interest rate? The interest rate will be stated. Okay, we will give you in exam. We will give you how much is the interest rate. Okay, if you are talking about real life application, real life scenario, you want to start your business, you want to apply for the interest, for the loan. Okay, in case you want to know how much is the interest, you can ask the bank will state the interest to you. Okay, basically the nominal rate, right? Okay, so the interest will be stated. But in terms of dividend, you cannot simply ask, for example, your shareholders, how much dividend do you want? Because here, remember, we are doing this analysis before we start the business. So at this point, you do not have your shareholders yet. Okay, you haven't collected the capital yet. So to whom are you going to ask? Okay, can you ask existing shareholders from different company, different businesses? No, because they have different expectation. Okay, maybe they have different expectation towards their own business compared to your shareholders to have their expectation towards your business in the future. Okay, remember, we are doing this analysis before we start the business. Okay, so right now we don't have anyone to ask. So in this case, how do we get the rate of dividend? We get the rate of dividend through using CAPM, capital asset pricing model. Okay, this formula. Okay, don't worry about memorizing this formula, because again, in finance, we will provide the required formula to you, except the formula for depreciation. Okay, any unrelated formula to finance, we only give you the formula related to finance, yeah, because there was this one time students ask in final exam, where is the formula for depreciation? We don't provide you with that. Okay, formulas that related to other courses. Depreciation is related to accounting, right? Okay, you have to memorize them. Okay, now for this one, okay, RS is basically the CAPM. Okay, okay, let's look at RRF. Okay, this is the rate of risk free. RF stands for risk free. Okay, so rate of risk free. If I can ask you, okay, what investment in the market that is risk free doesn't have any risk at all? Okay, we have agreed that there is no investment, right, that is practically risk free. But how about it's almost risk free? Basically, the investment that is offered by the government, right? Because we are talking about when it comes to risk in investment, the risk we are talking about is the risk where our investment fails. Okay, if our investment fails, for example, let's talk about fixed deposit. How can a fixed deposit fail? Fixed deposit would be failing if they can't pay us our interest. And how can that happen? That could happen if the bank goes bankrupt. Okay, so when we talk about investment that almost never fail, we are talking about government instrument. okay, treasury bills, bonds, okay, because it's almost impossible for the government, the whole government, to fail. Okay, so in this case, when we talk about risk, a rate of risk-free, okay, here we are talking about the government securities. Next is the rate of the market return. RM is rate of the market return. Okay, and the rate of market return, for example, okay, here we are talking when we talk about rate of risk free, this is our benchmark. If, for example, people ask you, if I invest in my money today, how much do I get? How much will I be able to get? Guaranteed investment. Okay, we are using the government rate. Okay, let's say treasury bills pays us 3% today, so we will tell the we will tell the investors that, okay, you will get 3%. How can you be sure? Because this is what the government paid. How can you be sure that I'm going to get 3%? Because government will never fail. You will certainly get your 3%. Okay. So here RM refers to the risk of the market return. Okay. The highest at any given point. So when we take the highest return at any given point from the market, this includes obviously the private sector, the securities market, the capital market, all the markets, okay, minus the rate of risk-free, the benchmark, the lowest, okay, we will get what we call as premium, market premium. Okay, and this is beta. Beta is basically systematic risk. Beta basically talks about the risk associated with certain industry. If we are talking about, for example, automotive industry, okay, maybe they have a beta value of 1.2. If, for example, we are talking about consumer-based product, maybe they are more sustainable. Maybe the beta is maybe 0.8 or even 1. Okay. And if, let's say, for example, we are talking about seasonal business, maybe their beta is very high, very volatile, for example, 5 even. Okay. So here, you don't have to worry about beta at this point because in exam, we will provide you the beta. But in case you're wondering, what is firm beta? Firm beta is basically the systematic risk that only affect the business due to their nature. Okay, due to their industry. Okay, firm data from one industry to another would be different because different risks affect different industry. Okay, but at this point we don't test you on that, we only test you on the calculation part. Okay, so okay, this is an example you can refer in your module. This is taken from your module anyway. Okay, so risk-free rate in this case 4%. This is the government rate. Okay, implied market return, this is the RM 7.83, and we take 7.83, look back at the formula, okay, market return minus risk-free rate, okay, 7.83 minus 4.01, we get 3.82. Okay, this is the figure that we are looking for. Okay, and we put into the formula. Okay, so let's say this is the tak ada what recording. Okay, all right. Okay, so this is the formula. Okay, and this is the result. So what is this? Okay, RS is the required return. Okay, RS is the required return. So basically, we are talking about if people ask you, if I want to go into business today, how much should I pay as the dividend? This would be the rate. Okay, minimum that we have to pay is 12.5668%. Okay, based on the market risk, the minimum market risk, the extra portion, and also we have the firm beta, basically the volatility of the market return. Okay, all right. We can say that from this, just to explain, okay, why it looks quite high. Okay, if you look at here, 7.83 is the highest that the market could pay. You see here? Okay, at this point, on this date, okay, in September 2023, the highest would be 7.83%, implied market return 7.83%. Okay, but okay, as you can see, yeah, where is the point anyway? Oh, kat ujung ni, kat ujung ni nampak. Kat ujung ni, kan? I thought it was like this line. Okay, sebenarnya tengok bulat ni. Okay, bulat ni kat ujung ni, kan? You tengok sini eh. Okay, the highest would be 7.83. So, if for example, just want to like tinker your mind sikit, kan? I want to stimulate your thinking sikit. Okay. If the market pays the highest at 7.83%, why should we pay even higher than that? It is because our business is volatile, high risk, but at the same time, investors would expect us to provide higher reward. Okay, for example, if they take high risk, but if for example, okay, you calculate this, okay, the rate of dividend that we need to pay is minimum 12.5668%, and we look at the highest market return. But the market only pays 7.8%. Why should I pay more? Okay, and we decide to pay only 7%. Okay, the investors will not be happy. Why? Because the firm beta, the systematic risk, the risk that your business experience is higher. Okay, if you're talking about industry average, in the stock market average, this beta would be 1. Okay, if your beta is 1%, sorry, the is ratio system 1 to 1. Okay, you should get this. Okay, you should get this. Okay, but your risk is practically more than double, 2.24. Okay, so you cannot pay this much. You have to pay more. Okay, so this is basically the reasoning behind the use of CAPM. Okay, now let's look at this formula. Okay, let's look at this working. WACC. Okay, so what is WACC? Okay, firstly, we have cap cost of debt, then we have cost of equity using CAPM. Next, we have what we call as weighted average cost of capital. Now, weighted average cost of capital. What does it mean? It means that, okay, it's very rare that businesses only rely on one specific type of capital. Okay. Uh, Most businesses, they won't just take loans, they won't just sell shares. They would be doing both. They would sell shares and at the same time they would take loans. So in this case, how much is the cost of capital? We have to take the average. Okay, let's look at this example to understand this better. Okay, look at the capital. Okay, the equity is 25,000 and the loans is 25,000. Okay, so the debt is 25,000 ringgit and then equity is 25,000 ringgit. Now, firstly, we have to find the weight. Okay, WACC, weighted average. We have to find the weight. Okay, 25,000 ringgit. What is the weight from the total capital? What is the total capital? Total capital with plus both, right? Okay, so, okay, 25,000 ringgit. Okay, this one, yeah, this one, 25,000 ringgit divided by total capital. Okay, so we get 50%. And similarly, for equity, it would be 50%. So the total percentage must equal to 100%. Okay, if you calculate it's not 100%, it means that you still have more capitals that you need to calculate. Okay, so this is the first part. And second part, okay, let's look at the question. Okay, should the bank charge 5%? Okay, so the rate here for the debt is 5%. Whereas from the calculation earlier, if I'm not mistaken, this is a rate. Let's see. All right. If I'm not mistaken, yeah. Yeah, correct. Okay. So this is the rate. If people ask us, so how much is the rate of your how much is the cost of your capital? We can't see 5% because 5% only comprise of half. Okay, half of our capital costs 5%, whereas half of our capital costs 12.5668. So we need to find the average. That's why we call this as weighted average. Okay, so now we have to average it. Okay, so the calculation should be 50% times 5%. And remember, okay, for loans, okay, the interest is tax deductible. Okay, so we cannot stop at here. Okay, we have to minus we have to include the tax portion. Okay, so minus 1 point. For example, let's use the example here. The how much is the tax? I think the tax here is 24%. Okay, so minus 0.24 or 24%. Okay, so this is the first part of WACC. Okay, cost of debt plus this is the cost of equity, 50% times 12.5668%. Okay, so this is the formula and this is the working. Sorry, this is the answer. Okay, so the answer would be 8.183. Okay, betul ke? 8 yeah, 8.18. Okay, so this is the first part, the cost of capital. Okay. Next is the estimation of cash flow. Okay, I'm going to pause the recording for now because it's 9 a.m. My workshop is starting. I will continue the recording in the afternoon, maybe at 10 a.m. while we are taking our morning break. Okay, so I'm pausing now. Mm, how can I? Yeah, I never done this. Okay, maybe I can just stop our recording and maybe I will start recording later. Okay, let's try this. Hopefully it works.